So thank you for joining us today. For those of you who are new to our monthly webinars, my name is Erica Lockhart.
And I'm Lorin Ruttenberg.
And together we are Ahead of the Curve Homes with Compass. Today we're actually joined by Michael Most, who is a senior loan officer at Guaranteed Rate. So he is going to have some great finance strategies as it pertains to our topic. And speaking of which, each month we focus on a different topic. And today we're going to cover the very stressful topic of how to buy and sell at the same time. We recognize that buying a house is probably like one of the most stressful life events that anyone can go through. But it's actually doubled when you're trying to sell your current home at the same time. So today we'll provide you with tips and strategies on how to hopefully make the process a little less stressful.
Exactly. And so while we're going through things, if anybody has a question, you just take your cursor and move it around over the picture, and at the bottom of the screen you're going to see something pop up that says chat, and all you do is click on the chat button and type in your question, and we will address your questions. Okay. But the first thing I think is to show you the market stats that we have prepared. So I'm just going to share my screen. There we go. And here's our topic: need to sell in order to buy, learn how to manage the process. Did our introductions. So here we go.
Okay, so we'll start with the key neighborhoods, Baldwin Hills, Baldwin, Vista, View Park, Ladera, and Windsor Hills. So here we see that 2020 October new listings and pending sales are actually down pretty significantly at 54% and 48% respectively. There's no apparent, rhyme or reason as to why volume is down. This is probably the first month that we've seen volume dip this drastically. It could be the result of the pandemic. It could just be seasonal as we approach the holidays. I think it's going to be very interesting to see how these figures change in the coming months of November and December. I think the coming months will really kind of tell a story. And then days on market decreased by 36% and closed sales decreased by 14%. And while overall volume and activity decreased, excuse me, the average sales price did see a healthy 16% gain. Okay, so looking at the October condo market, here new listings are down by 67% and pending sales are also down. And total sales decreased, and average days on market actually decreased by 80%, and average sales price increased by 7%. So the condo market in these neighborhoods is truly mirroring exactly what we just reviewed with the single family home market. So in terms of volume being down across the board, but the sales price is increasing.
Okay, and then we travel to Mar Vista, and it's very interesting. The new listing inventory in October of 2020 rose significantly as compared to October 2019. So a 31% increase in new listings year over year, and then also a 31% increase in pending sales year over year. So very active market. A 40% increase in the amount of sold single family homes, and which is also, a big gain. And then the most interesting thing is that the days on market went down. So even though there was more inventory, they were staying on the market for a shorter period of time. And it's usually the opposite of that. Usually the more inventory you have, the longer things stay on the market. And the average sales price did go down by 14%, but that's also expected. With so much more inventory, you would expect that there's just a broader range of sales prices, and it went down a little bit. And then we go to the condo market, and again, new listings. Now with condos, I'm not that surprised because people are really trying to, we have found in our own listings that condos are harder to sell right now, and that people really want to get houses. People really want to have a backyard and their own private space. So, so a lot of people are selling their condos right now. So the condo inventory went up by 47%. The pending sales went up by 40%. And the sold listings went down. Okay, so that's interesting that the inventory went way up on condos, but the amount of listings sold actually decreased by 11%. And the average days on market, it stayed 39 versus 33. So the average days on market did go up a little bit, which is to be expected with more listings. So the average days on market went up 15%. And the price stayed very flat, really. It went up 7%, but not a huge difference.
Okay, so moving on to Culver City single family. New listings are up slightly from 18 to 28 listings. Pending sales are also up by 18% and total sales by 32%. And the average sales price here also increased by 9%. So Culver City is definitely showing signs, and honestly continues to show signs, of a very robust and active real estate market in spite of everything that's going on. So looking at the Culver City condo townhome market, overall new listings were up by 7%. Pending sales are up by 47%, same with closed sales by 57%. And the average sales price had a pretty minimal decrease of 3%. And then here, if you just look at 2019 versus 2020, the Culver City condo market, it continues to outperform the previous year. And we've honestly been seeing this trend the last few months. I think a lot of homeowners who currently live in condos as a result of the pandemic and staying at home for so long, they're just craving more space. And what they're really also craving is outdoor space. And in many cases, condos and townhomes just simply don't provide that. So I think that's really fueling the number of new listings that we're seeing in Culver City specifically.
Yeah. And then in Santa Monica, single family homes, new listings, I mean, it stayed pretty flat, the same, really, it went up by 3%. There's one more new listing in 2020 than there was in October of 2019. The amount of pending sales went down by 54%, but the amount of sold sales stayed relatively the same, 4% difference, 24 sold in 2020, 25 in 2019. The average days on market went down a lot, which is interesting. So things selling much quicker. And the average sales price went down by about 15% in Santa Monica to just about $3 million versus $3.5. But the most interesting thing in Santa Monica is the condos. Look at how many new listings came on the market in October of 2020 versus October of 2019. So that's like crazy, 46%. And again, that's because people want to, I think it's because people want to get into a home and they want to get out of condos. And especially in Santa Monica, a lot of the condos are pretty tight. In Culver City, you have a lot of developments that have grounds and they have land and they have places for people to go outside. But in Santa Monica, you don't necessarily have that. So the new listings went up by 46%. The pending listings went up by 13%, and the sold listings went up by 12%. So it's like going down like this. The average days on market went up by 2 days, which is a 4% difference. And the sales price went down by 30%. So it's going to be really interesting over the next few months to see how this inventory that came on in October actually percolates through the market and to see what happens with it, if it all sells or whatnot. But definitely people are trying to get into single family homes. That's the message. So hold on. Did I stop the share, you guys?
Yeah.
I just had, there we go.
So now we'll get into just some Q&A as it specifically pertains to selling and buying at the same time. So we'll turn it over to you, Rodney, for the questions.
Thank you, Erica. So hello, everyone. I'm the office assistant for our team, and I have a few questions to start our Q&A. And my first question starts with Erica. What are the benefits of selling before buying?
So I think for a lot of homeowners, honestly, the greatest benefit is it's truly financial. So you won't have the stress of paying for 2 mortgages at the same time, which could be very daunting. And then also you may not even qualify to carry 2 mortgages. So this option can be ideal for those, with less than stellar credit, or for those that simply don't have enough income to support 2 mortgages. Another benefit is that cash will be easily accessible for a down payment for your new property. Also, I think as a seller, you'll have a better idea of the equity that can be put into your new home. So until you list your home, you really don't know. So hypothetically speaking, you may list your home for $800,000 and open escrow at that price at $800,000. But what if it doesn't appraise, or what if you end up negotiating a $50,000 or $75,000 credit or price reduction? You now potentially have $50,000 or $75,000 less than what you were anticipating, and this could potentially impact the budget for your replacement home. So selling kind of right before you buy, or doing it at the same time rather, it really helps you solidify a budget. And then lastly, peace of mind. You don't have to worry about moving twice, and you'll be able to let go of one home before taking on the responsibility of a new home, which can make things feel a lot more like properly ordered and just less stressful.
Thank you, Erica. And Lorin, are there any disadvantages to selling and buying at the same time? Are there any disadvantages?
Well, I mean, depending on how it's structured, there's different ways to go about it. So depending on how it's structured, you could and likely would end up with 2 mortgages at the same time, even if it's for a short period of time. So you have to be mentally and financially prepared for that. You can also try to do a contingent offer, and what a contingent offer is making your purchase of the new property contingent on the sale of the departing residence. So I'll talk more about that in a minute. That is an option, but the disadvantage of that is that 2 sales really depend on one buyer. So the one buyer who's coming along to buy your departing residence is really depending on what they do. If they drop out, or if they have problems or can't complete the escrow, 2 deals fall out of escrow, because you're not going to be able to buy the up-leg property without that buyer. And all I would say is about selling and buying at the same time is that it really requires a mindset of flexibility, because there are so many variables along the way, because there's people involved with every transaction. So if you're the type of person that really needs to know exactly how it's going to work out, where you're going, what you're doing, it's probably best for you to just sell first, because it does require a certain amount of, we'll figure it out, it'll be okay kind of attitude.
Thank you. And Erica, what are some of the circumstances where a seller may need to sell their home before they buy their next home?
So as I mentioned earlier, many sellers may need to sell their home first if they don't qualify for 2 mortgages at once. And then some sellers simply may not have the savings, the reserves, or the funds needed for the down payment for their next home, because it's tied up in the equity of their existing home. So they'll have to actually sell in order to get access to those funds, to that cash.
Okay. And Lorin, this next question is for you. What strategies are available to sellers who need to sell in order to buy?
Okay, so the first strategy is a contingent offer, like I was saying. So a contingent offer means you make an offer on your up-leg property contingent on the sale of your departing residence, okay? And there's many different situations. It can work. We have done transactions like that. But it just depends. It depends a lot on the departing residence. As a listing agent, if I get a contingent offer on one of my listings, I want to know where the departing residence is, what the market is like there. For instance, if I'm selling a house on a great street in Santa Monica, and I know I'm going to price it really competitively, we know that that's going to get multiple offers. There's going to be a huge market. It's a very desirable property, and we know that it's not going to be a problem to sell. But if it's like, a house that might not be as desirable or not priced as well, it's going to be harder to get your offer accepted on the up-leg property, depending on what the contingent sale looks like. It's not impossible. If the up-leg property that you want to buy has multiple offers, it would be very hard to get a contingent offer accepted because if a seller has other options of someone who's just ready to go, they'll probably take that offer. But again, I don't want to paint a picture where it's impossible because we have done contingent offers. The most important thing is that the agent who's making the contingent offer for you on the upleg property is able to express, identify, provide data on the property that's on the departing residents, and to prove the case that this is a property that's going to go into escrow right away. We're going to get multiple offers. We're pricing it very aggressively. That's going to be the sales pitch for the upleg property. So that's one strategy. There's also the strategy of leasing back. So sellers can sell their property and they can lease back. They can become a tenant in their own property. So you sell and you lease back the property from the buyer, and that would get negotiated up front. One thing to keep in mind is that lenders, the buyer who's coming along and buying your property, let's say, they're probably approved, with a loan. I mean, if you're lucky, they have all cash, and then it's no problem. If they are getting a loan to buy your property, the lender will only allow them to lease the property out for about 30 days. If they're buying a property that's going to be leased for more than about 30 days, the lender will consider it income property, and then they can't get the same kind of loan, and the rates are usually higher. It won't be as competitive of a loan. So you might have to handle a lease outside of escrow. Sorry, Michael, so that the lender doesn't know about it. We have to hide we have to hide that from the lender. And one thing to expect if you're leasing the property back is that you're going to pay more monthly for the property than you would have with your mortgage, because most likely the buyer coming along is paying a higher price for your property, and so their monthly payment is going to be higher. And if you're going to cover their monthly payment, you're going to have to be prepared to pay a higher monthly rate than what you would have paid, just holding on when you live there as the owner. And then the third thing that we're going to get, you can also sell the property, like Erica said, and go and lease a temporary place. There's some, we always recommend Park La Brea. It's a great place they do temporary leases. It's a great location in the city, and it's pretty reasonable for temporary leases. They'll do like 3-month leases, 6-month leases at Park La Brea, which can help. But that may involve putting your stuff in storage. There's a lot of logistics involved with moving twice, and you just have to be prepared for that. But like Erica said, if you do that, you sell, you close, you go lease somewhere for a period of time, and then you buy, you have the cash on hand, it's clean, there's no contingent offer, you're ready, you can make a strong offer on your upleg property. And then finally, we're going to get into this with Michael, there could be lending solutions that would allow you to take money out of your house and buy a new property while staying in your property. So, those can be great options. You just have to be prepared that for some small period of time, at least, you will have 2 mortgages. But I'm going to let Michael talk about that.
Thank you, Lorin. So Erica, Lorin touched on the topic of offers a bit. And my question is, what's the best time to submit an offer on a replacement property?
So, obviously we're still in a very competitive market right now, and it's still very much a seller's market. So when you do submit your offer on a replacement property, you want to make sure it's as attractive as possible, obviously in terms of price and terms. But one way to ensure that your offer is attractive despite having the sale contingency in place is to submit an offer once you're in escrow on your departing residence. And to make your offer even more solid, you want to submit an offer once the buyer has removed all contingencies. So once your buyer on your departing residence has in fact removed all of their contingencies, this will give the listing agent, this will give the seller of the replacement property some peace of mind, knowing that the sale of your existing home is basically a done deal. And when submitting that offer, in addition to the offer, I would include copies of all of the buyer's contingency removals, so you have evidence to show that the buyer has in fact removed all contingencies. And then I would submit a copy of the estimated seller's net sheet to show what you're estimated to receive as a result of the sale in terms of your proceeds, so that you can confirm that you can in fact purchase the property, you have the funds for your down payment. So I would do all of those things to increase your chances of getting an offer accepted, because as Lorin mentioned, it's going to be very challenging submitting an offer with a sale contingency if you're competing against offers who don't have that contingency in place.
Okay.
I had one thought. You know what, but I'm sorry. Go on. It just flew out of my mind. I had something really important to say when you were saying it, and then it flew out of my mind.
So that was the last question that I had for me. And we're going to transition into opening the topic with Michael.
Okay.
You guys really didn't leave me much. You have such well-trained agents. I think you kind of answered all the financing questions. So,
but like, there's so many questions on financing, like how do people make those things work, and what kind of loans are out there, and what do they need to qualify, and all that.
Got it. So, I mean, do you have, Rodney, do you have questions that are specific to me, or do you want me to just cover the topics?
Yes, I have a few questions that are tailored for you.
Okay, so then before you hit me with the questions, let me just run through the overall process. I'll try to do this as quickly as possible and not regurgitate any of the information that Lorin and Erica laid out for you guys. So there's basically 4 ways to do this from a financing standpoint. One is sell and buy same day. As they both pointed out, that could be quite challenging because you have a lot of people a lot of different people to manage in terms of expectations. I literally closed the second one today. I just closed the deal like that based out of New York. The guy sold his condo and bought his home in New Jersey, to your point on the market, because everyone's getting out of condos and buying into homes. So, but they came to me on October 1st and said, hey, as quickly as you want to close as the bank, we'll be ready. Well, guess what? I was ready on October 28th. I wanted to close at the end of the month. And between then and now, 12 days, 13 days later, was, to Lorin's point, figuring out all the different lawyers and all the different people and the moving and everything else. It took an extra 10 days to coordinate between both sides. So it's ideal for the buyer, because if he's selling his place, getting the cash, and then moving to the next place, great. And he gets the cheapest mortgage. He gets not to have to carry 2 mortgages and things of that nature. So by far, it's the best for the buyer, but not a very easy transaction. Then you have what's called buy to sell without contingencies. So if the buyer is selling his place, doesn't need the money from selling his place, and can qualify to carry both loans, or he even has a buyer to purchase his home, but they're cash or non-contingent, and it doesn't matter, then the banks can wipe out all that debt, that leverage that sits over his head, and close that way. I would tell you that deal probably happens about less than 10% of the time. Most of the time, that's very hard to find. Having said that, that is a second option. Then you have what's popularly known as the bridge loan, cross collateral, which is kind of a way of saying, hey, how do I cross collateralize and bridge the equity I have in the home I'm selling to the home I want to purchase? So that's doable. What is known as bridge loans is more labeled today as cross collateral. Well, they will lend you money based on the combined collateral of the two. Again, higher interest rate, more difficult to do, but an option available for someone that couldn't get into one of the first 2 options. So while they are sitting on the equity, it's quite doable. I would tell you the hardest cross collateral deal that I've ever come across is sometimes people call and say, I got no money. I literally have no money, and all my money is locked up in my home. So now you got to work out a cross collateral deal where the sellers and escrow don't really have anything to hold on to. So it's got to be kind of a desperate seller in some senses when you put that deal together. but they are doable where you can combine. So if I'm selling my home, to give you quick numbers, I'm selling my home for $1 million, and I have like a $200,000 loan in it. So I have $800,000 worth of equity. And now I want to go buy a different place that's going to be worth 1.5. So I want to step up. So how do you bridge the two? They'll take the $1 million value on the sale. The $1.5 million on the new place is $2.5 million worth of property that you own, cross-collateralize on the $2.5 million worth of home that you own by putting them together. That's in a short sense what a cross-collateral is. Last but not least is rent departing. So a lot of times what you'll find happen is the borrower qualifies, but doesn't actually want to go into contract yet because he wants to buy now because he found the property that him and his wife likes to purchase, but he doesn't want to sell so quickly because he doesn't want the pressure of having to sell under a fire sale. So then what they'll do is sometimes they'll rent it or they'll get a tenant to rent the departing resident while still qualifying because they have enough cash and income to buy the new place and not feeling that pressure of having to sell their departing place. So departing to rent is also a term that's used where you can use that to purchase. So I'll stop here. Those are the basic four. Does anyone have any questions on that?
I do have one. I mean, Erica and I dealt with a situation last year. Sometimes, especially in LA, if someone's lived in their house for a really long time, they have this insane amount of equity in the house. I mean, over 30 years, it's gone up so much. So we have dealt with people who take an equity line out, they pull the cash out. We can't put the house on the market while that's happening. They have to get the cash out of the house. Then they buy the next property with cash. You know, especially this is like if people are downsizing, older people who have just tremendous equity, maybe they want to go from a house to a condo or from a bigger house to a smaller house, less maintenance. But often those people are like on a fixed income too, you know, so can you talk about that a little bit?
So great point. Let me ask you roughly, how long ago was that deal that you referred to? And I'll tell you where I'm going with this.
Last year.
Last year. Okay, so that makes the most amount of sense because what drives every structure of every deal, does anyone want to take a guess? What drives every single finance deal?
Interest rates.
Market.
I'm going to go with Lorin. Interest rates. What should drive every single financial decision, Erica, should be the market. But what does drive every single buyer is interest rates. So interesting to your point, Lorin, which is what used to be is home equity loans were easier to get and were set at significantly lower interest rates. So much easier to just pull the cash out of my house while interest rates were higher on purchases and become a cash buyer on purchases. However, that's now flipped post-COVID, post-COVID, I don't even know if we are post-COVID, whatever, during the COVID world we live in. And now because interest rates are so low on the purchase and the home equity has a much higher interest rate, now nobody wants to go touch their equity on their home because they're like, how do I always get to my cheapest interest rate? So how can I now carry both loans and whatnot? But to your point from a real estate perspective, yeah, 10 times easier. Go pull the cash out, buy it, and then replenish it the other way. But sometimes people get overwhelmed and confused with that because there's two transactions going on at the same time. But I also cover, as Lorin knows, the New York market. And in the New York City market, that is a lot more prevalent, where cash buyers are not just one step above a finance buyer, they're about 10 steps above. So if you can get the equity out of your home in New York or whatever other assets you have and become a cash buyer in New York, you'll see that's a lot more prominent there, where they'll pull the equity out and then just buy all cash.
And let me ask you a question. Is there any penalty? Like, I know that the deal that we did, the woman, she paid a penalty because she sold her house. She only had the new loan for like, I don't know, 45 days or whatever. So she did, and she knew that was coming. You know,
Yep.
We told her that up front. So are there always, once you pull an equity line, how long are you supposed to keep the house until, you know, how long are you supposed to not sell until the penalty goes away?
So not to digress, I'll keep it very quickly, but the way banks make money is what's called a yield spread premium. A yield spread premium means that regardless of what interest rate I give someone, whether it's 2, 3, 4, or 6%, we do not make money on the interest rate. There's an investor that bought into a mortgage-backed security. They make better returns and how they swap those securities on Wall Street. That's the investor. The actual bank makes money on a monthly service premium. So every month, the bank gets paid a premium. So where does the bank figure out its profits? They say, okay, the average loan in this tranche of, let's say, a $300,000 loan versus a $1 million loan versus whatever, how long will we service this loan? Divide that out by the premium they get per month, and that's how they come up with their pricing. So what happens in your scenario is the challenge is they're not making $1 because you sold this thing off within 3 months or 6 months. What did they make? $150? But meanwhile, it costed them overhead to actually do the loan. So in general, home equities, to answer your question, all have a 2 to 3 year penalty, like prepayment penalty on a home equity to pay them off. On regular fixed mortgages, you'll find that either people will pay that fee up front and tell the bank, look, I'm paying this thing off anyway, so what do you need to make? You need to make 100 basis points, 1 point. I'll just pay you the fee now. And if I decide to pay off the loan in 30 days, 60 days, 90 days, it is what it is, but you didn't lose out on your money. But in general, that I hope answers the question. It has to do with when they get to at least recoup their money. And they're not in the business of giving money for free, right? So they need to know that their premiums are being paid.
Yeah, I think it's just like when we have that situation, just making people aware of, it might still be worth it. You just pay the point, pay the fee, you know, but it's just about people being aware that there is such a fee, you know? Yeah. Okay. Rodney?
So I'll go to Rodney.
Yes. So my first question for you is, what finance options exist?
Other than the 4 we just listed, you mean?
Yeah,
Or,
I think we covered that.
yeah.
I would move on to number 2, Rodney.
So speaking about what's involved in qualifying for the new house while you still own the old one, what are the necessary qualifications from the bank's point of view?
Good question. So they, like they do on any regular loan, whether or not there's a departing residence there, the bank always has a seesaw of debt versus income. So depending on which is known as your DTI, your debt versus your income ratio, depending on what your debt versus your income is, the bank will qualify you. So almost similarly, it's literally 2 sides of an Excel sheet. The same way if someone has a car loan and they have a Maserati and they're paying $2,000 a month, and that's on their debt side, that's how they're going to calculate this home. How much is the home costing in terms of the mortgage or no mortgage? Let's say there's no mortgage on it, just property taxes, HOA fees if it's a condo. And they just add that to the debt side to make sure that the income, which the client is receiving on a monthly basis, is enough for them to be able to pay both loans. So the first question that always comes up from people is, well, I'm going to sell it in 3 months. So what are you worried about? And I have enough in my savings account to make those for 3 months. The issue there is once we close on the loan as a bank, we have no idea what you're doing, right? So we don't know that it's sold 3 months later. We're not holding an escrow for it or anything. What happens if, God forbid, it doesn't sell? And now fast forward a year or 2, and this person now, God forbid, has to foreclose on this new home they bought. It comes back for review under an audit, and they go, well, why did you lend this person money? And we say, well, because we hoped they would sell it within 90 days. We'd have a real issue. So it's really about once we close a loan, it is what it is the day of closing. So making sure that someone has the ability to be able to cover both those loans, whether it's short-term or long-term.
Okay. And we may have touched on this, but what loans exist for the new residents that can be paid down and have payments adjusted once departing resident sells?
I'm sorry, I was distracted. Someone put up a great question on the chat. Sorry, Rod.
Okay.
I wasn't sure. Go ahead.
Yeah, and I'll ensure to read your question that's in the chat. So it's what loans exist for the new residents that can be paid down and have payments adjusted once departing resident sells?
Great question. So that's what's known in the industry as a recast. Not to be confused with a refinance or any other terms that the banks may use, or people like sometimes get confused with. What a recast means is that I owe $1 million. And let's say I am in a bonus structure of income, or if I'm going to, in this situation, sell my home, or I'm coming into an inheritance. At any point that someone has a lump sum of principal, they can apply it as a one-time lump sum payment to their loan. So let me give you an example. We'll run through numbers slowly. I take out $1 million loan because I'm short on money and I need to go sell my other place. I then go sell my place. Or my other examples, I come into a bonus of $100,000. I get an inheritance. At whatever point, I come into $200,000 worth of money. I can call the existing servicer, say, hi, I took out $1 million loan with you. I'd like to send you in $200,000 worth of principal. What they will do is recalibrate the payments based on the new balance, which is $800,000 in my scenario, using the same exact interest rate that they closed with. It's not a refinance. It's just a recalibration of payments. And even if, let's say this was a year or 3 years after I took out the loan, so now I'm 27 years left on my 30-year loan, they will also use the existing amortization. So they will not take you back to 30 years. So it's basically, you have to look at it, and I always dummy it down to like, someone lent me money and I'm paying them back over the course of time. If I come to them and say, hey, I'm going to give you back a lot of your money right now. Okay, so now what do I owe you? Well, you owe me based on what you still owe me, right? Similar to like adjustable rate mortgages. And on an adjustable rate mortgage, you could prepay money or pay down money as much as you'd like, because when it resets, it's based on what you still owe the bank. So it's a recast option, very, very popular in this scenario where you're selling to then buy, but you're going to come into a lump sum of cash. And what we will do as lenders is show the borrower, okay, so for the next 6 months, you have these big payments on that $1 million loan, but guess what? After you sell and pay this down, here's what your payments will look like in the future.
Okay. So you touched a little bit on the process of getting started. What do you need from a seller specifically? Is there anything?
On a seller specifically for which scenario?
For the process of,
Like in terms of the finance options, what would be, I guess, a seller's first step?
Oh, I see what you're saying. A seller that's going to then eventually buy. So the first thing they need to do is get on the phone with the bank and work through a lot of these numbers. Because what the bank is going to first do is put all their debt on one side and all their income on another side. So what I always do is the first question I have on a deal like this when someone calls me is, okay, we need to separate income and assets here. So first things first, what do you have in terms of, I always start with assets. Because if you have no assets and they're all locked up in that home, we're right away going down a very different kind of road. If they tell me, no, I got money, or my family can lend me $250,000, like money's not the problem. I don't need the money out of the house. Now I could put that on the side and say, okay, now let's talk about your income. Can you qualify to carry both? If you can, great. If you can't, do we need to do a rent to sell? Or do we need to do something like a non-contingent sale? Or do we have to sell the same day that you buy, right? Then I got to go down those slippery roads, but that's only if they don't qualify with enough income or if they don't have enough assets. So therefore I need the assets out of the property.
Thank you. So we have one question in the chat and it says, what about a refi option? Refi the mortgage on the current house, use that cash for down payment, then sell current house, while then prepping to sell original house.
And then like
Yep.
prepping to buy the new place simultaneously.
Yep.
Mm-hmm.
So there's two ways that scenario goes down, Roxanne. One is that you're going to do that with a plan to sell the current place within months,
Mm-hmm.
or there's no timetable when to sell that. So depending on which one of those two roads your mindset's at, you'll either go into a bridge financing loan. If it's really short term, then we do cross collateral bridge financing, where we just quickly pull the money out based on a double deal. And then, as I said before, we'll recast and recalibrate the payments afterwards.
Mm-hmm.
And the other is based on long term, because You might want to rent it or whatnot,
Mhm.
do anything.
Mhm.
So I could share with you, I had a deal about a year and a half ago. They came to me and we did a cross collateral because they had a ton of equity in their home. They were selling in Playa Vista and moving to Culver City and they had a ton of equity. So we did a cross collateral and basically got them almost 100% financing on the
Mhm.
purchase because it really wasn't, it was 100% of the purchase by using the equity that was sitting in the other home. But guess what? The week of closing, because of the program we put them into, we got them a 5-year interest-only arm. At that point, this is going to sound like a high rate today, but at that point, a year and a half ago, it was only about 3.5%. Well, guess what? After we closed, they decided, you know something, with the 3.5% interest-only loan, I'm actually going to spend 6 months and do work to the home and fix it up before I decide to sell it. And as you can imagine where this story is going, I kept following up with them to refinance because they had this lump sum of cash that came in. It took them close to over a year. We just closed their refinance like in this past April because once they were in that cross collateral loan, they were like, okay, it's not killing them on the interest only payments. And they decided to fix up the house. It worked out to their favor because then because of COVID, they were able to sell for a much higher price. That it was fixed up and the market was a little hotter when they were looking to sell. So the cross collateral loans are not like a gun to their head where like, oh my God, you have to sell in the next 3 to 6 months. They are there if you want to hold on to them as long as you'd like, or have the option to pay them off and pay them down.
Thank you, Michael. That was our last question for this evening.
Cool. Thank you, everybody. And thank you, Lorin and Erica, and our gracious host, Rodney. So thank you, everybody, for attending.
Thank you. Yeah.
Thank you. Any more questions before we leave?
Can I just ask a follow-up, maybe afterwards, more like related to my scenario?
Go ahead.
Sure.
Oh, ask now?
Yeah, you can, or unless
Oh,
you.
sure. I don't mind. I mean, I'm just thinking too, like I have a duplex in Englewood. It's got tenants. I'm contemplating selling. I'm trying to like figure out the timeline to buy where I am now, which is in the Bay Area. So I was thinking that was kind of like my question about like the refi, like because the interest rates are low now, take out a chunk of cash, sit on it. When the time is right to buy, and then repay on the higher mortgage for the property in Englewood. But so does that become the collateral loan that you were talking about, or what would be like a sensible timeline, I guess, especially considering that it's rental income and there's, you know, a little bit of profit being made on with the tenants?
So the first and most important thing is to first know how much equity is sitting in the duplex. So especially if you're going to cash out on an investment duplex, there has to be a lot of equity. So sometimes people call and they're like, well, there's 20% worth of equity in it. So can I get 5 or 10% of it? No, at best, you're probably going to be at 70% of the value on a cash out. And those rates are extremely high at 70%. The most aggressive rates are close. I actually had this exact deal this morning. And the guy has like 50% of equity in the home. And even at 50%, he's got to pay points and he's getting a rate in the 4s. So he locked up today 4.25, 30-year fixed, 50% loan to value, but he got $250,000 out of the home because that house is worth like 1.1 and he only owed like 300 to Lorin's earlier point, bought it a long time ago and it's built up a ton of equity. So I don't know your exact scenario, but if there's a ton of equity sitting in the home and it's now worth so much more, it's a great idea. But if there's not a lot of equity, you might not be able to get it out anyway.
Right. I see. Okay.
But I know 2 great agents. They might even be on this call.
I come to these every month, so I'm sure they'll be getting a phone call soon, I'm sure.
Well, just not to digress too much, but right before we got on this call, I just had a call from a client who says, you know, my wife and her sister want to buy a duplex together.
Oh, really?
And
in Englewood, near the farm?
But can we get something in Englewood? So literally 15 minutes before I got on this call, he just called me.
Yeah, the house and an in-law suite. I'll call you.
Right.
Well, thank you so much, Michael, for joining us today.
Thank you guys. Appreciate it.
Roxanne, we'll make sure you have Michael's info.
Yes, please.
Thank you so much. And
Yeah.
everybody, let us know if you have topics that are your burning desire to know about, or you want us to cover something, let us know. We'll cover it.
Great. Thank you.
Thanks, everyone. Have a good night.
Bye.
Bye.